Hi, I'm John, and welcome back to another one of our insurance videos. In our last video, we provided an overview of life insurance, the reasons to purchase life insurance, and how to determine the amount of insurance you might need. Today, we're going to be talking about a specific type of life insurance, and that is going to be term life insurance. Generally speaking, term life insurance offers the greatest amount of coverage for the lowest initial cost. The policy has a death benefit that will pay to your beneficiary, but it has no cash value. With a term insurance policy, your premium will be guaranteed to remain level for a specified period of time, or the term of the policy, and at the end of the term, the policy can stay in force, but the premium will increase. As long as you pay the premium, the policy will remain in force. It's pretty simple. The price of the term policy is based basically on the age of the person and the health of the person over the period of time that they're in the term. So for this next couple of examples, we're going to look at a 21-year-old. So let's say a really healthy 21-year-old male purchased a $1 million policy and they want to have a term of 30 years. It might cost $75 a month for that 30-year term. That very same policy, if they want a term of 10 years, might only cost about $35 a month. So why the difference? So in the 30-year term, you're taking a person from 21 to 51, and you're averaging basically all of those premiums over those individual years for those 30 years, versus in the 10-year term, you're taking a person from 21 to 31 and averaging that premium over 10 years. So that's why it's less in those instances. So why would a 21-year-old want to get either a 10-year term or a 30-year term? So first of all, you want, if they're really healthy, they can establish insurability, and once that policy is in force, as long as they maintain the premiums, they'll always have that policy. So if you're 21 and you buy a 30-year term, if you develop a medical condition that might otherwise prevent you from getting life insurance at, say, age 40, that policy is still in force, and you can continue to keep it in force as long as you pay the premiums. One of the benefits of a term life policy is that you can convert the term life policy, typically without having to show evidence of insurability or going through underwriting again, for the same amount or a lesser amount to a permanent type policy. We'll talk about those types of policies in the next lesson, but buying a term policy for a short period of time, especially say you're a 21-year-old, you're new in your career, you expect in 10 years to be able to afford a larger policy, at that point you might want to convert it. So you buy it as much as you can at 21, you get to about 28, 29, or 30, you say, I'm going to convert this policy to a whole life policy where it can do different things for me and accumulate a cash value. So those are just a couple of reasons why you might want to use a term in those conditions. Another example for using a 10-year term versus a 30-year term is, let's say that there's somebody who retires at 55 and they start receiving a pension benefit. Well, in some instances, their spouse may not have any spousal benefit to that pension if that person were to die before they reach a certain age. So they might buy a 10-year term policy, which will be a little bit more expensive at, say, 55 than it was, say, at 25. But what that allow them to do is provide some spousal benefit if something happens to them before the retirement and the pension is able to be paid to the spouse at a later age, like 65. Finally, we're going to talk about another type of policy, or another type of term policy, called a decreasing term. And typically you see a decreasing term policy for, let's say, when somebody has a mortgage, and whether it's a 15-year mortgage or a 30-year mortgage or something in between, they could buy a term policy to cover the cost of the mortgage, so that if something happened to them while the mortgage was still being paid off, they would be able to pay the mortgage off by this term life policy. In the decreasing term policy, let's say that you have a $100,000 term policy that, say, a 30-year-old purchases. It'll start as a $400,000 policy in year one, but over the course of the number of years that mortgage is being paid off, it'll reduce in value. And so, unlike the premium will stay level, but it'll be based on a decreasing amount of life insurance as opposed to a steady life insurance in our other examples. So that's a quick introduction to term life insurance. If you have any questions, call us at 303-443-1288, or you can email me at jstringfellow@farmersagent.com. Thank you.